Hello, I'm Ed Crooks, the US Industry and Energy Editor at the FT, and I also write the Energy Source newsletter. Over the past few weeks, we've been asking readers to submit questions, and now I'm going to be answering a few. First, we have a question from Jennifer Lowe. Why is the energy market so volatile, and what factors affect its volatility? The oil market is indeed spectacularly volatile, as we've seen in the swing in prices from over $115 per barrel in the summer of 2014 to less than $30 earlier this year. The principal reason is that both supply and demand for oil are very hard to adjust. On the supply side, much of the oil we use comes from mega projects in deep water or the oil sands of Canada that take many years to bring into production. So supply responds only very slowly to higher prices. And when prices fall, companies can actually pump more oil, not less, for a while as they try to maintain their revenues. So the price signals actually go the wrong way. On the demand side, it takes time for people to change their cars to more or less fuel-efficient models, or to change their habits so they drive more or less often in response to changes in price. So given that price is such a blunt instrument for bringing supply and demand into balance, it can take big moves in prices to rebalance it when it's out of whack, as it is at the moment with excess supply. Second question is from Pat Roche. We were told that many US tight oil producers weren't sustainable even at $100 oil. Yet here we are, 20 months later, after prices began to slide, and US tight oil production hasn't significantly dropped. Were the reports of high decline rates exaggerated? Well, no, they weren't. The high decline rates are still there, but we have seen some big improvements in productivity. Each rig is drilling more wells now, and each well is producing more oil. So in aggregate, total US production has held up, even though the individual wells are still declining. Production can't defy gravity forever, though. Output in the Bakken Formation of North Dakota and the Eagle Ford Shale of Texas has already started falling, and the main US shale oil producers have been saying they expect their production to fall further this year. By the end of the year, US production is expected to be well below its peak. And finally, Akram Hassan Hamoudi asks, where do you see oil prices going? The most honest answer is, I don't know. Given the volatility of oil prices that I was just talking about earlier, predicting future moves is very difficult. Rex Tillerson, the chief executive of ExxonMobil, said recently that 41 years in the oil business hadn't taught him anything about how to predict movements in the price of oil. It had just taught him how to handle those movements. But that said, if I had to guess, I would say that oil is likely to rise in price over the next 5 years or so. Today's prices are just not high enough to make it worthwhile for companies to make the investments that will be needed to meet future demand. The price may not go up very much from here, we shall see. But I think it's very unlikely to stay at today's levels down below $40. That's all for now, but thank you very much for all your questions, and don't forget to sign up for the Energy Source newsletter to take part in future Q&As.